Welcome back to Profit Without Panic. This is lesson number 14. I'm Karl Domm, and today we're diving into how to employ leverage with advanced margin strategies, a core element of the all market profit strategy. In this lesson, I'm going to explore one of the most powerful tools for traders, margin. When used properly, margin can unlock serious advantages, making your capital work harder for you. Most traders are familiar with Reg T or regular margin, but in this video, we'll dive into advanced strategies using portfolio margin and or span margin, which can help you weather market events, diversify your portfolio, and make trading more efficient, potentially increasing your returns. Let's start by understanding the different types of margin. Number one, Reg T margin. Reg T is the most common type of margin offered by brokers. It provides a 2-to-1 leverage, meaning for every dollar you have, you can control $2 worth of positions. However, this margin is based on the full risk of the trade at expiration in a risk graph, which can tie up a lot of capital. Number two, portfolio margin. Portfolio margin, on the other hand, assesses the risk of the entire portfolio instead of individual trades. And this can significantly lower your margin requirements and maximize your buying power. Typically, you need a minimum of around $100,000 to qualify for portfolio margin. Number three, span margin. Span margin, which stands for Standard Portfolio Analysis of Risk, is a risk-based margin calculation used primarily for futures and options on futures. It's similar to portfolio margin, but designed specifically for these types of trades, offering reduced margin requirements even for traders with capital as low as $2,000. So how do you calculate these margins? Portfolio and span margin use a more complex approach than Reg T. They factor in the overall risk across a range of scenarios. Let's break it down using an unbalanced iron condor as an example. Imagine regular margin requires $12,000 to hold this position. By using portfolio or span margin, you might only need $5,000. So that's a huge difference, freeing up more capital to allocate elsewhere. One of the biggest advantages to using portfolio and span margin is the ability to manage your trades early and optimize returns. For example, when trading options, you're not forced to wait until expiration to realize profits. You can manage trades when they reach profit targets early, freeing up capital for other opportunities. This makes your trading more efficient and can significantly improve your return. So let's look at some numbers. If you need $12,000 with regular margin for a $1,000 profit target, that's about an 8.3% return on capital. But with portfolio or span margin, you might only need $5,000 for the same $1,000 profit target, giving you a much higher 20% return on capital. Advanced margin strategies also provide greater flexibility in trade selection. With the increased buying power that comes with portfolio and span margin, you can consider more complex option strategies like unsymmetrical multi-leg strategies that require more margin but offer unique risk-reward profiles. This can help you better navigate various market conditions. Another powerful advantage of advanced margin strategies is something called profit stacking. Imagine you have $100,000 in your account, and with span or portfolio margin, you could buy $100,000 worth of Treasury bonds, earning 1 to 4% annually, and still have around $99,000 of margin available to trade options. Essentially, you've doubled your buying power by trading with approximately $200,000 using just $100,000. While the benefits are clear, it's important to recognize the risk. Increased leverage. Increased leverage means more buying power, but it also means more potential for losses if a trade moves against you. Margin expansion. Margin expansion can occur as markets shift, forcing you to add more capital or reduce positions to meet the new requirements. And finally, managing these strategies requires a deeper understanding of margin calculations and ongoing monitoring of your account to avoid overexposure. By wisely employing advanced margin strategies like portfolio and span margin, traders can unlock the full potential of their capital, achieve higher returns, and diversify their portfolios. Just remember, with great leverage comes great responsibility, so manage your risk carefully. If you're interested in learning how I've researched, back-tested, and developed a trade plan specifically designed to control risk using portfolio and or span margin, click the link in the description for more details to get in touch. In the next lesson, I'll dive into the key strategies for minimizing drawdowns through crash-proof position sizing. Position sizing is important because it helps protect against unexpected increases in margin requirements due to market volatility, preventing forced liquidations or margin calls that could wipe out an account. Proper sizing ensures traders can maintain control over their positions even in adverse market conditions, safeguarding capital and maintaining long-term trading viability. Click the video on your screen to continue to the next lesson. Just remember, with great leverage comes great responsibility, so manage your risk carefully.